After studying this module, you shall be able to know what commodity markets are and who can become a member of MCX. Learn what are various orders and circuit breakers. Learn how trade takes place in commodity markets. Understand various methodology of computing margins. Introduction. Who can become a broker or a member of MCX? Commodity trading in India during the past few years has attracted attention of many, including hedgers, speculators, arbitrageurs. This has brought many an entrepreneur to seek membership or brokership of a commodity exchange, including the MCX. Minimum eligibility criteria to become a new member or broker of MCX is that a person should be an Indian citizen, his age should not be of less than 21 years, he should have 2 years working experience. Types of membership. There are different kinds of memberships available at MCX. A trading cum clearing membership of MCX is available to individual or proprietary firms, registered partnership firms, corporate bodies, HUF, cooperative bodies. They can be institutional trading cum clearing member for entities like trade and industry association, corporate entities, corporate institution, corporate bodies and large retail network and commodity brokers. Some of the members are only professional clearing members. This membership is available for banks and financial institutions. MCX exchange operates on all days except Sundays and exchange specified holidays. The exchange notifies a list of holidays for each calendar year in advance. The trading is undertaken from Monday to Friday 10 a.m. to 5 p.m. for all commodities launched by MCX. Monday to Friday 5 p.m. to 11:30 p.m. is the trading time for all commodities except agro commodities. On Saturday too, trading takes place from 10 a.m. to 2 p.m. for all commodities. What are the different terms in contract specification? Various relevant features of the commodity are provided in a contract. This includes trading unit, which is the minimum quantity for a contract that can be bought or sold. For example, if a member is buying one lot of cardamom, he has to buy minimum 100 kgs of cardamom given trading unit of 100 kgs. Base value refers to the quantity units for which the price are quoted for online trading on TWS. For example, if the quotation of base value for gold contract is given as 10 grams and the price available for trading on TWS is 8,000, that is that the price for 10 grams of gold. Maximum order size is the maximum number of lots that can be bought or sold in one single order. Tick size is the minimum price difference between the bids and the asks for a particular contract. The tick size is given in the contract specification. DPR is the daily price limit, that is the circuit filter limit, is the percentage of variation allowed in the price of a commodity in a day with respect to previous day's close price for the day. DDR is due date rate, is final settlement price for particular future contract and calculation process called computation of DDR. What is base price? When a new commodity is introduced for trading, it does not have any reference price. Base price is a reference price used for launching or commencing new futures, commodity or contracts. On the basis of that daily price range, it gets adjusted. What are the types of order in commodity market? The types of order in commodity markets. There are different kinds of orders which a member can execute on behalf of the client. The first is limit order, specifying the price at or better than which the trade should be executed. Market order should be executed at whatever is the prevailing market price at touch line on or after submission of such order. If there is no market price at that point of time, it takes the last traded price and remains in the system. If there is no LTP, which is the last traded price, then the system confirms the order with the same side or the counter side touch line, and if there are no orders at the touch line and no LTP, then system confirms the price as previous day's close price. Stop loss order. This order is generally placed for the purpose of avoiding heavy losses while trading in the market. Stop loss price is kept by the system in suspended or abeyance mode and is activated only on a trigger of price as defined by the member. Orders can be classified based on the period as end of the session EOS are available for execution during the current trading session until executed or cancelled. All EOS orders will get cancelled at the end of the day during which such orders were submitted. Good till date, which are available for execution till end of the date indicated in the order or till the last trading day of that contract month, whichever is earlier. Good till cancel, which is available for execution till maturity of the contract or till it is cancelled by the member or the user, whichever is earlier. Immediate or cancel IOC orders will get cancelled if not executed on submission of such an order. Such orders will not remain in the order book. Day order are available for execution during the current trading until executed or cancelled. All day orders will get cancelled at the end of the day during which such orders were submitted. What are circuit filters and security deposit? Circuit filter. The sharp fluctuations in the price can bring about huge losses to the players in the market. To put a check on such fluctuations, circuit filters are introduced. The exchange notifies such daily circuit filter limit for futures contract in terms of percentage of intraday variation allowed in a day with respect to the close price of the previous day. Circuit filter provides the maximum range within which a contract can be traded during the day. Such circuit filter is different for different commodities. The orders which are in violation of such circuit filters are rejected by the system. What deposits does a member have to keep with the exchange and what exposure the member will get against it? Security deposit. It is given in two stages. Initial security deposit. It's given at the initial stage, which is revised from time to time when the membership is taken and is considered for giving the exposure to the members. Rupees 15 lakhs for trading cum clearing member, non-deposit based, and rupees 50 lakhs for trading cum clearing member, deposit based. Professional clearing member and institutional trading cum clearing member, that is available towards exposure limit. This security deposit has a lock-in period of 3 years. In case a member wants to increase its trading, it needs to give additional security deposit if the member maintains rupees 50 lakh in cash and gives an undertaking for the same. Then he can give the bank guarantee and or FDR of any amount, that is 1:3 ratio is not required to be maintained. Shares of the approved companies and or the warehouse receipts of approved commodities are also accepted as collateral for additional margin. Forms of additional deposit. Bank guarantee. The bank guarantee instrument should be for a minimum period of 1 year and a maximum period of 3 years, excluding claim period of minimum 45 days. The bank on behalf of the member must issue the bank guarantee. The processing of bank guarantee instruments is validation and upload into the system will take at least 3 working days. Fixed deposit receipts. Members may submit fixed deposit receipts (FDRs) issued by the approved banks for the purpose of additional deposit. The FDR should be accompanied by the bank lien and members lien letter. The processing of fixed deposit instrument, its validation and upload in the system will take at least 3 working days, and therefore the members will be entitled to get additional exposure limit at least after 3 working days from receipt thereof by the exchange if required. Different types of margins collected by the exchange are as follows. Ordinary or initial margin. Ordinary margin requirement is calculated by applying the margin percentage applicable for a contract on the value of the open position of a member in that contract. If a member has net position in various contracts of the same commodity running concurrently, he is required to pay margin separately on each of these contracts at client level. Similarly, if a member has open position in various commodities, the total amount required is calculated as sum total of margin required in respect of each commodities and contracts separately. The computation methodology in respect of ordinary margin is as follows. Intraday, during the trading session, the margin is calculated on the absolute difference between total sales in value terms and total buy in value terms in respect of all transactions executed in a contract during the day at client level, in addition to previous day's open position carried forward at the closing price of the previous day. End of day, at the end of trading session, the margin amount is computed at client level on net position in a contract in quantitative terms multiplied by the official closing price. What are circuit filters and security deposits? There are two kinds of settlements. Positions can be settled either by way of closing it out at daily settlement price on each day and due date rate on expiry of contract, and or by way of delivery. Daily settlement, each trading day shall be settlement for the purpose of avoiding counterparty risk. Therefore, all transactions in contract shall be subject to market and settlement through the clearing house. The exchange has the right to effect marking to market and settlements through the clearing house more than once during the course of a working day if deemed fit on account of the market risk and other parameters. Members can settle his position any time by taking the opposite position. Settlement of differences due on outstanding transactions shall be made by clearing members through the clearing banks. There shall be a daily settlement price in respect of each future contract. The settlement procedures can be briefed as: settlement on MCX takes place on a T+1 basis, that is daily settlement or daily mark to market settlement. There are two types of settlements on MCX: marking open position of the member to the daily settlement close price for mark to market settlement. Delivery settlement is effected only when delivery is given or taken during contract maturity month and closing out of residual open position at DDR depending on the delivery option. What is the settlement period and what is the settlement guarantee fund? Settlement period is the cycle which includes trade execution to settlement of that trade. Daily settlement includes trades done on that day and are settled by way of MTM, profit or loss, on the next working day, that is on T+1 basis. The exchange maintains the settlement guarantee fund. Whenever a clearing member fails to meet his settlement obligations to the exchange arising out of the transaction, or whenever a clearing member is declared a defaulter, the exchange may utilize the settlement guarantee to fulfill the obligation. This helps in building up the confidence of the players in the market. What is marked to market MTM settlement and what are special margins? MTM settlement means that any notional and or booked losses or profits of the members based on outstanding position at the end of a trading day and loss or gain on T+1 day is either debited or credited to members' settlement account. This notional gain on open positions at the end of the trading day are computed with reference to the closing price of the said contract with the traded price of the contract. For example, the traded price is ₹100 and the closing price is ₹90. Then the buyer of the contract shall have to pay for the loss of 10 to the seller of the contract. Special margin are applied in case of sharp fluctuations in prices. In case the price fluctuation in a contract during the trading session is more than 50% of the circuit filter limit, a special margin equivalent to 50% of the circuit filter limit or as specified by the exchange is applied. Such special margin amount is immediately reflected in utilized margin of the members having outstanding position in that contract, and in case the available margin of a member is not sufficient to cover such special margin required, and then a margin call is sent to the member which is required to be remitted by the member immediately. In such case, since the available deposit is already exhausted, he is put in square off mode and the same continues during such trading session till collection of required margin amount is completed or member squares off his position. Tender period / delivery period margin. When a contract enters into a tender period, delivery period towards the end of its life cycle, tender period margin is imposed. Tender margin is mentioned in the contract specification and is applicable on both outstanding buy and sell position, which continues up to the marking of delivery obligation or expiry of the contract, whichever is earlier. The delivery period margin is also applied on the marked quantity and is calculated at the rate specified for respective commodity multiplied by the marked quantity at the expiring contract. When a seller submits delivery documents, his position is treated as settled considering early pay in, and his tender period or delivery period margin to such an extent is reduced. When a buyer pays money for the delivery allocated to him, his delivery period margin is reduced on such quantity for which he has paid the amount. If delivery does not happen with respect to certain open position and is finally settled by way of difference as per the due date rate, the delivery period margin is released only after final settlement of differences arising out of such closing out as per the due date rate. Procedure for payment and receipt of delivery of commodity, pay in and pay out. Pay in and pay out for MTM settlement differs from delivery settlement. Pay in and pay out of funds for mark to market settlement is effected on T+1 basis. Pay in and pay out of funds for delivery based settlement is effected on E+2 divided by E+3, where E stands for expiry of contract basis for delivery of good delivery by the seller or as prescribed in the contract specification. What should a member do if he has utilized 100% of his margin? When a member uses or utilizes 100% of his margin, he has the following option. He has to deposit additional margin in his settlement account and inform the exchange to debit it, thereby increasing his exposure. Otherwise, he is supposed to square off existing positions, thereby liquidating and hence releasing margins. Members can square off their position from their terminals as on utilizing 100% margins. The member is put in square off mode. For trading in the commodity markets, the trader needs to have the spot price information. This information is available at the trader's workstation or TWS of the members and can be viewed in the column underlying asset in market watch screen. Even historical data of commodities traded on MCX is also available on the website www.mcxindia.com before the beginning of trading during the following day. It is available in the link Bhav copy, which is date wise, and Bhav copy commodity wise. What are the different delivery options? A contract can have any of the following options: both option, seller option, compulsory option. Both option. In case of both option, contract delivery will take place only if both buyer and seller give their intention to take give delivery. In other words, delivery takes place if intention from both buyer and seller is received and is for matched quantity. Balance open position of the member will be closed out at DDR. Seller's option. Delivery is based on seller's choice. If seller gives intention to give delivery, buyer has to take delivery at the expiry of the contract against outstanding positions. The buyer can intimate to exchange before pay in date of funds about refusal of delivery, and the refusal / failure of buyer to take delivery will attract penalty. Sellers not giving intention and keeps open position at expiry also attracts penalty. Compulsory option. In compulsory delivery contract, all open position at expiry will result in delivery. In case of failure / refusal from buyer or seller, the penalty will be levied to member whoever fails to honor their respective obligation. What is delivery lot? Delivery lot is the minimum deliverable quantity in units a member can deliver at the time of tendering delivery. The delivery lots are specified in contract specification of the commodity to be tendered for delivery. The delivery can only be tendered in multiples of delivery lot. What is delivery procedure? Delivery procedure at a glance. Members enter into a contract at a certain rate. Contract nearing expiry enters into tender period. On delivery, marking date delivery will be allocated or marked. Seller member has to deposit goods at the accredited warehouse. Buyer members have to make pay of funds on scheduled pay in day. Pay out of funds will be made to seller member on scheduled pay out day. The details of buyer will be intimated to seller to enable to raise invoice. The seller has to raise the invoice under intimation to exchange. Buying member can lift delivery after pay-in of funds. For lifting delivery from warehouse, the member has to submit representative details that who will lift delivery. Exchange will issue delivery order to warehouse on basis of which warehouse will release goods to buyer members' representatives. Member interested in giving or taking delivery can give their intention during intention period. The seller has to give documentary evidence of deposit of the commodity with exchange designated warehouse only after delivery is marked and obligation is honored. Buyer has to submit details of client on which invoice has to be raised. The client of seller member raises invoice in the name of the client of buyer member. Both parties must have LST/CST/VAT registration. In case approximate tax registration is not available, a commission agent can be appointed for raising the invoice. Tender period margin. Commodity markets have an additional margin mechanism to ensure the tendering of the delivery. When a contract enters into tender period towards the end of its life cycle, tender period margin is imposed. Such margins are applicable on both outstanding buy and sell side, which continues up to the marking of delivery or expiry of the contract, whichever is earlier. The tender period margin is calculated at the rate specified for respective commodity multiplied by the net open position held by a member in the expiring contract. It varies from commodity to commodity for which the member has given delivery. Delivery period margin. When a contract gets closer to the delivery period margin is imposed. This is in addition to the normal margins in place. The delivery period margin is calculated at the rate specified for respective commodity multiplied by the net open position held by a member in the contract. Such margin is applied on the positions marked by the exchange. Delivery marking or matching. In the commodity, mark is the delivery of the commodity has different option. In case of seller option contract, the delivery marking is done to buyer on the basis of intention received from the seller. If the seller has expressed his interest in delivery of the contract, buyer shall have to take the delivery. In case of refusal, buyer will be charged penalty. In other option or both option, the marking will be done on expiry of the contract after trading hours only if both buyer and seller give the intention to give or take delivery. In another case of compulsory option, the marking is done on contract expiry date after trading hours to all buyers and sellers who have not settled as yet, that is having open position. This means that they will have to take or give delivery on compulsory basis, failing which they would be liable to pay penalty. Summary. Commodities trading has gathered a lot of attention during the last few years in India, primarily on account of the sharp fluctuations in the commodity prices internationally. The strong linkage of the Indian market with international trends have made all the connected parties from producers to processors to consumers to be on their toes to avoid losses airing out of these sharp fluctuations. Commodity trading in a formalized way through futures markets like MCX or NCDEX has helped the stakeholders to avoid losses by taking hedging positions in the commodity market. The understanding of the commodity trading therefore has become highly significant for corporate to farmers, primarily for hedging. It has also created a market for speculators and arbitrage to take advantage of the fluctuations in the price of commodities from crude oil to gold to agricultural commodities.